Good morning, everybody, and welcome to our Saturday webinar this morning. And we have come with something that's absolutely topical, on the mind for everybody, and obviously a little concerning. But we have something here to allay your concerns, give you a little bit of a realistic picture of how the market is today and what can we really look into going forward from here. So, welcome to our webinar this 11th of April on the current status of the Iran-US-Israel conflict and what does it have to do with your portfolio. I'll take you through a series of what we have to share with you, and then at the end, we can have a set of questions. So at that point, you can unmute yourself and we can answer those questions. Yes. So here we are with what we have to share with you on the Iran-US-Israel conflict and what does it have to do with your portfolio. So we believe the market creates three different types of investors. War and crisis create a lot of noise. And apart from that noise, your portfolio needs a certain set of rules. So what are the different kinds of investors? One category is described as the victim. They react emotionally to the current conditions in the market. They exit the market due to the headlines and not because they really need that money for any specific need right now. So example is selling the equity because a war is on somewhere else and it has impacted your portfolio at this moment. Another set are described as the opportunists who wait for some kind of clarity. Saying, okay, I will take out the money from the market right now, or I have money to put in the market, but I will wait for some more clarity in terms of where this is going. So for them, the clarity arrives a little late. And by that time, the market has actually rebounded. So they have missed the opportunity. The market often recovers much earlier than when the investor's confidence comes back. And the third type are the ignorance. When we say ignorant, they're market ignorant, or they ignore the noise around the market. They stay aligned with the long-term plan and they keep investing as per the plan that has been set for them. And this is the group that consistently builds wealth over time. They do nothing other than continue what they've been told to do. So what happens at Happy Investor, our role is to help you to remain in this basket where you are ignorant in action, but you're not unaware in the understanding of what's happening around. We have been sharing our own way of information that would help you. Now, this is how these three segments perform in the market. As you can see in this chart, you have three different lines. You have a blue line, which has been ascending. Yes, it's jagged, it's up and down, but finally it is going up. You have the olive line, which is also going up, but not at the same level. And then you have a flat line after the initial phase. So these are the three different baskets where the investor, all the three investors started at the same point by investing a lakh in the market in Jan 2007. They all stayed in the market till Feb 2009. But at that stage, the segments got bifurcated. The market ignorant that we spoke about, they stayed invested in the market. The opportunist exited the market over here and then waited for clarity to enter and entered over here. Or those who had money but didn't want to put in at that point, they entered at a later stage. And those who were scared with what happened in the market, saying, my 1 lakh went up and has come down below its purchase price. So I will exit and keep my money safe. And then they stayed out of the market all along. So what happened? The ignorant stayed invested, and over a period of time, the one lakh that had actually gone down in value recovered and grew to almost twice that amount by the time it was end of end of 2015. While for the opportunist who exited the market and then waited, but waited for almost a year to re-enter, when they re-entered, that amount continued to grow, but could not even reach that one lakh. While for the person who totally exited the market, he remained with the exit value, which was around 64,000 as compared to the 1 lakh. Now, this is a real life situation. These are real life numbers of the index movement between Jan 2007 and 2015. We are showing you these numbers because this is a similar kind of situation where between Feb 2008 and March 2009, the market went through a phase of almost a depression. And then we had the global financial crisis hitting in 2008. And that's when a lot of people either made money or lost money, depending on what their action was. So this is to show you that even not doing anything when markets are all in a tumble is a better way to play the long term. Now, that is history. What are we looking at in the current scenario? So in the current scenario, there could be different probabilities. And we are coming up with what we have analyzed and what we are looking forward to as possible scenarios, and also letting you know what can be done. The first scenario is a quick conflict and a quick de-escalation where we have a 50% chance. And we had put this together a few days earlier. And we also know now that currently the conflict has come into a status of status quo with no action for some time. And we would know shortly where that escalation is going. But we expect maybe a 50% probability that the escalation would go down quickly. A total fall of maybe 10 to 15%, and a recovery phase of about 2 months. And what would we suggest as a strategy here? Stay invested, do not panic, and use this volatility to accumulate your units through either your regular SIPs that are going, or if you have the liquidity, you can add some lump sums, which will then help to work your near-term goals between 3 to 5 years. This is the current scenario, is what we feel. The second option is a longer war, but limited only to the Middle East, where the probability is about 35%. In this, we can expect a fall of about 20% from the high, a longer recovery period of about a year. So this helps the SIP investors because then for the next 1 year, your SIPs will pick units at a lower cost, which means you get more units and your rupee cost averaging kicks in. And when the market recovers, this phase that you added in will actually give you better returns and boost your portfolio. So we suggest SIP investors to stay the course, don't make any changes. Yes, if you can increase your SIPs on a monthly basis, increase what you're putting in, that can also help. The third scenario would be a major escalation across different major powers, for which we feel the probability is much lower. But if it does happen, could impact the market to about 20% down. And the recovery phase could anyway be more than a year to 2 years. Now, here the strategy would be, in case you have any goals which are within 2 years, please review what is the current status of what you have assigned for that goal and what is your request. And fresh money to be deployed in phased strategies. You can add something now, add in another quarter, structure it in over a period of next 12 to 20. What's the principle behind all of this? Do not let a geopolitical event come in between and make a permanent financial mistake. Yes, you might want to look at some kind of realignment, but that realignment has to be in context or in connection with your requirements. It should not be independent of your requirements. It has to be in line with that. If you do not have any near-term goals, then just continue on course and the recovery period will actually help your goals. And why are we saying that India is in a better position today? If we look at our current account deficit, we are in a less than a 2%. Our forex reserves have been at a record high. As of now, foreign private investors over here is not much because they are already underweight in India because they've exited and are now waiting to enter. And even our fiscal deficit in terms of our budget has been at the all-time low. So all these economic factors are pointing out towards a more stable Indian economy. And the fact that it's a stable Indian economy, that gives you more confidence that the Indian market is better placed to recover faster than most other economies. And there's historical proof of this as well. So in the global financial crisis, the market fell 55%, but recovered in 18 months. In 2013, where you had the taper tantrum, the market fell about 20%, but we recovered in 8 months. In the COVID crash, net drop was about 38 to 40%, and we recovered in 7 months. So what is all this telling us? The Indian equity markets have recovered even when markets have dropped 30 to 40% down within 12 to 24 months in the past instances. So India is not immune to the global market conditions, but it's better prepared and better positioned to absorb this kind of shakeup and recover sooner than other neighbors. So what does this mean for your portfolio? We need to think in terms of the timeline horizons of your requirement, not only the headline. So if you need money in 2 years, we need to review your risk and we need to avoid equity decisions because of fear. It's only if you have requirements within 2 years, which are not currently better placed, we need to review. So we need to keep the liquidity that you would require so that we reduce any event-driven kind of panic. And we have to prioritize your goal safety. So if that goal is in 2 years, then we need to ensure that what you need for that in 2 years is available for you and not disturb the rest of the basket. And if your horizon is 3 to 5 years more to go, stay invested, don't disturb the portfolio, and use this volatility to accumulate more at better prices. How can you do that? Keep SIPs running, add extra in tranches if it's possible and if it's needed, and let time do the work. Let's not predict where this is going. So lump sums not only can go in at one time, they can also be put in phased tranches whenever there is higher uncertainty. So basically what happens is we can't predict, though we just showed you certain probabilities of what options could come up. We can't really predict, but what we can control is the discipline of our action. That's within our controllable elements. What's our message to you? If you do not need this money in the next 2 years, stay calm. This phase will pass. If you, when you came to us, if you needed money in the next 2 to 3 years, we would never have recommended equity mutual funds for that requirement. So if we have planned your requirements for the next 2 to 3 years, rest assured it's not going to be disturbed by the ups and downs in the equity market that's currently happening. So be informed in what's happening, understand what is happening, but remain ignorant in action when it comes to your portfolio, unless, like we said, there is a specific need which is not going to be fulfilled because of this disturbance. Like they say, ignorance is bliss. So sometimes that ignorance and bliss is very important, especially in these certain conditions. So it's discipline and not prediction that is your biggest ally. And sometimes no action taken is the best action to actually take. So we are monitoring the situation closely. And if we feel that we need to reach out to you for any portfolio level action that is genuinely required, we will reach out to you and take that call along with you. So discipline and not prediction, and ignorant in action is what you need to do when it comes to your portfolio in the current circumstance. So when you remain ignorant in action, it actually creates wealth for you in the final outcome. So that's what we wanted to share with you. We hope you've been able to set aside your fears or allay your concerns. And if you have any queries, I can take those questions now. You can unmute yourself, or you can put in your question in the chat box.
Hello, madam.
Hello, madam. Yes.
Yeah, this is Samir Shah here.
Yes, Samir. Good morning.
Good morning. Thank you very much for
Thank
your
you.
kind information. I have one query regarding that. You mentioned that the market will be cover with that 55% down, so it will within 1 or 2 years it will be up, but nobody knows when it will be up. So that's the main question is then.
So, like I said, nobody can predict. Okay, that is our first premise. Yes, we've given you certain scenarios. These are possible scenarios with a certain level of probability, right?
Yeah, but how we can control our emotion on that?
So the idea for that is that do you do you need that money now? Do you need that money in the next 2 years? Whatever money you need in the next 2 years, that needs to be kept safe. Other than that, you need to ensure the rest of the money is not disturbed. That's the only discipline that you can hold. If you don't need the money in the next 2 years, don't disturb them. Money that you need in the next 2 to 3 years should not have been in the equity market. So ensure that that is kept safe.
Okay, got it. Thank you very much.
Yeah, thanks. Any other queries?
Hello, madam. I'm Sridhar here.
Yes, Mr. Sridhar, how are you doing?
Yes, I'm fine and can be better. Uh, I basically, of course, all my investments have been funds for the retirement planning. What is done
Yes,
while what you say gives some confidence, but as already mentioned earlier, somebody cannot control the emotions. Like
correct.
uh, our planning would be when I'm 62, the plan could be 85, 90 towards that age. Okay. But
Yes,
there are one serious concern, what I feel is like always. any service provider will have a safety basket saying that all risks are to the person who has done the investment. Okay. So where is the cutoff line, or where do you draw a line where still our invested money is safe, and where we need to come out is also uh, input to be provided from your end, and not that we'll be taken back, and then we will be in some sort of a thing there where we have planned for long term planning, and of course you always give an assurance 2 years, 3 years, but our planning would be for a still longer period.
Yes.
So how
Uh,
does this what confidence we can take, and how do we continue our investment with so many ups and downs in the market?
right. So what happens is that when we plan your investments as a retired person,
Yeah.
we will ensure that your medical emergency money is safe, not in the equity market. Your emergency money, other than that, for another 24 months, is not in the equity market.
Mhm.
Your expenses for the next 10 years, calculated at your current cost of expenses and taking into account inflation for the next 10 years, is not in the equity market.
Mhm.
So basically, you are safe for the next 10 years for whatever expenses that you would need. And like how we also showed you, the recovery period that happens for any kind of conflict that we have already gone through,
Mhm.
the global financial crisis, though the
Yeah.
market fell 55%, it recovered within 2 years.
Mhm. Yeah.
So, irrespective of what happens in the market and the drop that happens, the recovery phase does not go beyond 2 to 3 years. So, in the 10 years that we have kept safe for you, even if
Mhm.
the market goes down, it has time to recover. And since we are monitoring your retirement portfolio, it does
Yeah.
not mean that if 10 years, I'm telling you 10 years are safe, means it is safe from 2026 to 2036. No,
Okay.
that 10 years will also be rolling. Now, if you ask me in 2030, you will be safe from 2030 to 2040. So at every
Mhm.
point in time, we will ensure that your next 10 years requirements are never in the equity market, because we understand as a senior
Mhm.
citizen and as a retired person, there is no
Mhm.
going to be any additional funds coming into the basket.
Correct.
At the same time, money will be going out as per your requirements, and those
Mhm.
cannot change. They will only increase.
Okay.
So that rotation of baskets and amounts in each basket is monitored by us on a regular basis, and that decision will be taken as and when required to ensure that at any point in time, your next 10 years worth of expenses is not in the equity.
Okay. Thank you. Thank you. Thank you.
Yeah.
Good morning, ma'am.
Good morning.
Rohini here. Yeah,
Yes,
I
Rohini.
just wanted to know that can I have a better understanding about this lump sum investment? Like, is it one-time investment, or like I have to again do the additional investment for this over a time?
See, there are two ways of investing in the mutual fund market. You can invest on a monthly basis, a fixed amount on a fixed date, and
Okay.
that will continue to run on a regular basis with the fixed date and the fixed amount till such time that you want to change that amount.
Okay.
So, example, you started with a 20,000 monthly contribution that will run for a few months, and then when you feel like, you can increase that amount or decrease that. Apart from this, whenever you have an extra amount, say suppose you got your bonus, you got a 50,000 bonus,
Right.
that can be added at that one point in time.
Okay.
And it will get distributed and added into these same baskets based on the current market situation at that time. So it's like your piggy bank. You put money in your piggy bank every day, every month at a fixed time when you get your pocket money.
Mm-hmm.
But some elder in the family comes, there is some family function, there is some festival, you get some extra money, you put that also into your piggy bank.
Okay.
Same way it works over here.
Okay. So do I have any limit in the annual, like in particular 1 year I have to do only once or twice? There is any limitation for that?
No, there's no limitation for that.
Okay. Done. Thank you, ma'am.
Any further questions from anybody else?
There are a couple on the chat, Sujata.
Uh,
How should small investor, this is from Neeraj, how should small investors react during such global conflicts? Should we hold or invest more? Irrespective of small or big, the principle that holds is money that comes in for the short period of time will never be in the equity market. So any money that you need in the next 2 to 3 years is not in the equity market. So if your money is for the long term, please continue to keep your SIPs going. Add any money that you can add for the long term. Keep your short term money in a safer basket. I hope that answers the question. This is a question from Sujit. This can be really crazy, but in situations such as this, can we deploy into equity from or emergency fund in our portfolio? Once this mess settles, we can SIP into fill the hole. I didn't get your question correctly, Sujit. Could you unmute yourself and ask me the question? That would be easy.
Yeah, I'm in a very noisy place. But anyway, so we've got the fixed income part and the emergency fund, right? Can we uh, pull in some money from that into equity if this is like a 3 month or a 4 month? I mean, based if the probability is low for situations such as this, and then SIP our way into that fixed income and emergency, say maybe 6 months out to cover what we pulled
Yes,
up.
we can do that. I mean, technically, it sounds as an option that you should do, but we wouldn't pull out from the fixed income basket unless your immediate emergency is you have more than what you need for immediate emergency. Because an emergency, we don't know when it will hit. And in these current situations, we don't know what kind of emergency will hit. And then if we take out money which is actually meant for an emergency, and then the emergency hits, then your plan's gone for a toss. So if you have to move from fixed income to equity, we would suggest moving only that amount which is over and above your emergency.
Thanks.
can you just more elaborate on LWP?
May I know who's speaking? Samir?
Samisha. Yeah.
Yeah, so SWP is a concept to set up expenses for you post retirement. So while you work and while you earn, you invest through an SIP mode. And when you finish working and you don't have an active income, you still have expenses to take care of. So what you have accumulated and grown during your working years becomes your retirement corpus. And from that, we set up a monthly passive income for you. You might call it a pension, but it is a flexible plan. So we set up a monthly amount that gets credited into your bank from your mutual funds to take care of your expenses. And this can be adjusted up, it can be adjusted down, it can be stopped, it can be restarted, all with the flexibility of what you need rather than what the product says we can give you.
Okay.
Does that answer?
Thank you.
Yeah. Samir, since you've received our invitation and you've attended this program, on the invite, we have our QR code. You can reach out to us directly and we can help you set it up.
Sure.
Ma'am, Rohini here.
Yes, Rohini.
Is this a good time to increase my SIP amount?
If you have, if you have, uh, if you have excess money in hand, which, or rather, I'm not saying excess money. If you have buffer to your SIP, to what you're currently earning and what you're currently adding, and if you can keep that buffer running for some time, yes, it's a good time to increase. Like we said in the uh, presentation also, if your horizon for accumulating of this money is for 3 to 5 years more,
Mm-hmm.
keep your SIPs running.
Okay.
Okay. Also, we spoke about the recovery period of the market.
Yes.
And we said, suppose the market takes a year to recover, or say 2 years to recover, SIP investors will benefit. So stay invested, continue your SIPs, increase your SIPs if possible.
Okay, great.
So we have our QR code here, and you could scan that and get in touch with us directly on our office numbers, and we would be happy to help you with any further questions that you would have. Thank you for attending our session this Saturday. Thank you for taking out your precious time on a Saturday morning to join us. And we hope we were able to set aside certain concerns or fears that you had in mind. If you have anything further that you would like to speak to us directly, do get in touch with us. If you feel that your requirements need to be looked into, your portfolio needs to be reviewed, and you would like to check us to check something, we are always doing it at our end. But if you feel that there is a specific need because something has come up from your side, which we are not currently aware of, do reach out to us and we would be happy to help. Thank you so much for attending our session today. I shall close now. We will be back with something more interesting in a couple of weeks. Thank you and stay safe.